Hi everyone, it's Joel here, and today I'm going over the differences between the index funds, ETFs, and mutual funds. By knowing the differences between those three terms, it can help you save more money on management fees, and also it can help you increase your return on investment. Before we jump into the differences between the index funds, ETFs, and mutual funds, let's dive into their similarities of those three terms. By investing in either of those, you're owning a percentage of each asset inside the fund, and therefore your portfolio is more diversified compared to investing in an individual stock. More diversification leads to lower risk in your portfolio during the market downturn. Now let's look at the differences between index funds, ETFs, and mutual funds. According to Investopedia, index fund is a portfolio of stocks or bonds designed to mimic the performance of the market index. So for example, the most popular market index, which we usually refer to, is the S&P 500 index. For example, let's take a look at VFIX, which is Vanguard 500 Index Fund, and that mimics the performance of the S&P 500 market index. And this VFIX index fund has 507 stocks in its portfolio, so that's a little over 500 stocks. This index fund is very diversified because it is invested in different market sectors, such as energy, financials, real estate, tech, or other consumer discretionary, and many more. So for example, some market sectors are not doing well, some market sectors will be beating the market. So your portfolio will not experience high volatility compared to investing in an individual stock. Because individual stocks are more volatile compared to the index funds, and so during the market downturn, your portfolio would be more volatile and would experience more losses. This does not mean that you shouldn't invest in individual stocks. Well, it depends on your risk tolerance and your level of performance that you want in your portfolio. If you look at the assets that is under VFIX, you probably would know some of the top companies out there. So that would be Apple, Google, Facebook, Microsoft, Amazon, and the list goes on to 507. So the downside of investing in index fund is that you can only trade once a day, and that is at the end of the market hour, which is at 4 p.m. Eastern Time. On the other hand, for stocks, you can buy and sell them during the market hours from 9:30 to 4 p.m. Eastern Time. Another downside of investing in index fund is that some index funds require a minimal investment. And for example, for the case of VFIX, it requires $3,000 in minimum investment. So if you are a beginner investor and have lower than $3,000 to invest in the stock market, then VFIX is not an option for you because it requires $3,000 as a minimal investment. So what you can do is you can find an ETF version of VFIX, which I'm going to mention later in this video. So now let's go over ETFs. So what are ETFs anyway? So ETFs are called exchange traded funds, and because they are traded on the stock exchange. ETFs has a portfolio of stocks, commodities, or bonds under their portfolio depending on the types of fund you invest in. And also what's different from index fund is that ETFs are traded during the market hours, just like individual stocks. And because you can trade ETFs during the market hours, the price of ETFs will be more volatile than the price of the index funds. Also, what's different from index fund is that it doesn't require minimum investment. For example, let's take a look at ETF version of VFIX, which is VOO. The expense ratio of VOO ETF is only 0.03%, which is very low compared to other mutual funds, which I'm going to mention in the next section. So with 0.03%, with every $10,000 that you invest, you're only paying $3 per year in management fees, which is very low. Since VOO is an ETF version of VFIX, their performance would not be that different and would be pretty much comparable. How ETF is different from index fund is that it doesn't require a minimal investment. So at the time of recording this video, VOO ETF is around $363, and if you have $363 in your savings, then you can probably buy a share of one ETF of this VOO, and you do not require some minimal investment of $3,000 just like the V5X index fund. Now let's talk about mutual funds. And mutual funds also has a portfolio of assets like stocks, commodities, bonds, or other types of investments under the funds. What's different from index funds and ETFs is that mutual funds are actively managed by fund managers. And those fund managers don't work for free, so in any way they need to be compensated for their service. And those compensations come from investors' profits, so that really affects the performance of investors' portfolio. According to Investopedia, actively managed mutual funds charge somewhere between 0.5% to 1% in management fees. You might think 1% in management fee is not a lot, but if you think about it in a larger portfolio like $1 million investment into the fund, then the management fee would be costing around $10,000 per year. That $10,000 is a lot of money, because if it's costing you $10,000 per year, that means that's $100,000 in 10 years time frame. According to the data by SEC, 1% in annual fees can lower the portfolio by $30,000 in 20 years time frame compared to a portfolio with 0.25% in annual fees. And again, $30,000 is a lot of money, and you could be using it to make it grow using index funds or ETFs. According to CNBC, 80% of the active fund managers cannot beat the market. That means that every 4 out of 5 fund managers are underperforming and they are charging for the management fees. And I will be asking, like, why pay for management fees if 4 out of 5 fund managers are underperforming the market? But that does not mean that all fund managers are bad, because there will be some fund managers that are performing better than the market returns. But that would be an extremely rare cases. So now you have learned the differences between index funds, ETFs, and the mutual funds. So where should you put your money in? So definitely not the mutual funds because of the high management fees. So it all boils down to just ETFs and index funds. So for index funds, some of the index funds require minimum investments like $3,000. So if you have more than $3,000 to invest, then index funds are a great way to invest your money and get passive investing strategy going. But for ETFs, if you have lower than $3,000 in investment, then you can go with the ETF version and later on switch to index funds if you can. So for example, instead of investing in V5X, you could invest in VOO, and that you will also get similar returns compared to the returns of V5X. Another factor to consider is that how often you are going to trade for your investments, right? So for index funds, it's more of like a passive approach where you just buy it and hold it for long term, and because you don't trade that often. And for ETFs, you can trade during the market hours, so they are more like active and passive, I would say. But if you want to buy and hold, then that would be more of like a buy and hold passive strategy. But ETFs are easy to trade because they can be traded during the market hours. And the decision between choosing index funds and ETFs totally boils down to you, because at the end of the day, you need to make your own financial decision, and also make sure you know the pros and cons between those index funds and ETFs, because everyone's financial situation is totally different. That's a wrap for now. I hope you get a ton of value out of this video. If you get some value out of this video, please smash the like button for the algorithm, and make sure you subscribe my channel if you want more content just like this. And I make videos on personal finance, investing, and entrepreneurship. So if you are interested in any of those topics, then please subscribe to my channel and you will be updated when I post new videos on those topics. So thank you so much for watching, and I'll see you in the next video.